All right, I wanted to discuss a highly debatable topic. Is getting into debt a financial crime? Charlie Munger once said that there's only three ways a smart person can go broke: liquor, ladies, and leverage. And the first two are just mentioned because they start with an L, but it's really just leverage. Now, I know that's a pretty extreme statement, but nonetheless, pretty popular. There's also a handful of financial advisors who strongly advocate that everybody gets out of debt at all costs and stay debt free. Now, I would say that the average American spends way more than what their income allows for. As the income rises, the lifestyle also increases at a proportional rate or even at a higher pace. The average American doesn't have enough in retirement, savings, or rainy day funds. They're pretty much living just paycheck to paycheck. And if there's one hiccup, it just throws a giant wrench in the mix, right? And the family is just sent scrambling for options. In other words, the average American is not really financially responsible or disciplined. Now, for somebody like this, getting out of debt at any cost could be a good advice. Now, having said that, can we make a blanket statement and that it's the best strategy for everyone? Is it binary where getting in debt, any debt is bad? So I wanted to look at this subject a little bit closer. Obviously, getting out of debt is better than getting buried in debt, but there's an opportunity cost. Let's say somebody has a mortgage and it's 2021, so the mortgage is like 2.5%, 3%. By paying down the mortgage, making extra payments on the mortgage, you're essentially getting a 2.5 or 3% return. On the other hand, if you invest the money, let's say S&P 500 index fund, you can get 8 to 10%. I know in 2020 and 2021, the returns are a lot higher, but on the average, you're going to get about 8 to 10%. So, I mean, 8 to 10% versus, 2.5 or 3%. The way I look at it, debt is like a double-edged sword. For the unassuming and those who are not financially disciplined, it could be pretty dangerous. But if somebody is financially disciplined and responsible, they can take advantage of low interest loans and really supercharge their financial strategy. I also think that there's a common misconception that getting out of debt provides more financial security. But does it really? Let's take a look at a real life example. So we got two guys here, Dave and Robert. They both own the exact same house, worth $300,000. They put down 20%. Their loan is $240,000, amortized over 30 years, 3.5% interest, and their mortgage is $1,078. They both make the exact same money, $5,000 a month, and their living expenses $2,620. So both gentlemen have surplus of $1,302 after paying for everything. What Dave does is he takes the entire $1,302 and makes extra payment on his mortgage. Robert, he takes the $1,302 and puts it in the stock market instead of making extra payments on the mortgage, and he gets 9% returns. Let's fast forward 10 years and see what happens. Dave paid off his mortgage in just 10 short years. Instead of 30 years, he paid it down in 10 years. Great job. Robert still has a mortgage balance of $185,825. So he's still making the payment of $1,078 a month. The home value is $390,000 now. We assume 3% appreciation per year. So in 10 years, they're both worth $390,000. Since Dave doesn't have any mortgage, he has the full equity of $390,000. Robert, he has a mortgage balance, so his equity is a little bit lower. Now, when it comes to savings, since Dave put all his extra money in paying down the mortgage, he has zero savings. Robert, on the other hand, he was able to accumulate $252,000 by investing in the stock market with 9% returns. After 10 years, their income is still the same, $5,000, and the monthly expenses for Dave, it's a little bit lower because he doesn't have the mortgage payment anymore. And Robert, he's still making the mortgage payment, so his monthly expenses are higher. So the surplus at the end of the month, Dave is $2,380, and Robert is still only $1,302. You can see that Robert actually has higher total net worth than Dave. Robert's net worth is addition of his equity in the house plus his savings, and Dave's net worth is just the equity in his house. Now, let's think of a scenario where both guys get laid off at the same time. What's going to happen to Dave? He doesn't have any mortgage, so his living expenses are lower, but he also doesn't have any savings because all his money went down to paying down the mortgage. So even though his expenses are lower, he really doesn't have any options. Whereas Robert, even though his monthly expenses are higher, he has $252,000 saved up, and that's going to last him more than 5 years. So it's interesting that Robert, even though he has a loan, he actually has more buffer or cushion than Dave, who paid off his mortgage. If we fast forward 30 years, both guys are gonna pay off their mortgage. The home value is gonna be $570,000. Equity is gonna be the same. And let's look at the savings. Now, Dave, after 10 years, he's able to save more because he has lower living expenses. So he's able to save $2,380 a month, whereas Robert can only save $1,302 a month. However, Robert had a 10-year head start. So after 30 years, Robert will actually end up with more money than Dave. And it's a decent amount. Robert's going to be worth about $2.9 million, and Dave is going to be worth about $2.15 million. And we're going to assume that they are going to retire after 30 years, and they're just going to live off their savings. So that's one scenario. Let's take a look at the next scenario where it's the same story. We got Dave and Robert. They both got the same house, same loan, same expenses. But in this scenario, Robert actually buys an investment property. It's a fourplex worth $500,000. He puts down 20%, $100,000, and the loan is $400,000. Amortized over 30 years. The interest is 4%, a little bit higher than the primary residence. And we're going to assume cash flow, cash on cash of 10%, which means 10% of the invested equity. So the house returns $10,000 a year. We look at what happens after 10 years. Again, Dave paid off his mortgage. Robert still got remaining balance. So everything's same here. But Robert, he has $252,000 saved up. Out of that, he's going to take $100,000 and make the down payment. So his savings goes down to $152,000, but he still has $100,000 equity in the fourplex. So if you look at the total net worth, Dave still is only worth $390,000. Robert, you take his equity in the primary residence, you take his savings of $152,000 and his equity in the fourplex, and he's worth $456,000. You look at their income, they both make 5,000, but Robert has the additional 833 a month that comes from the cash flow of his investment property. Monthly expenses, Dave's monthly expense is only 2,620 because he paid off his mortgage. Now, Robert's monthly expense is a little higher because he's still paying the mortgage. But due to the additional income, they actually end up with similar amount of surplus cash at the end of the month. We fast forward 30 years, home value is the same. Now, Robert's fourplex is going to have increased equity because we also assume 3% appreciation. After 20 years, it's going to be worth 800,000. He's going to have 188,000 mortgage. So the equity on the investment property is going to be 611,000. So when you look at the total net worth, we're going to add the equity in the primary residence, the equity in the fourplex, and the savings from the stock market investment. And Robert's going to end up with about 3.5 million, and Dave is going to end up with about 2.1 million. And they both retired, but Dave has zero income. He's just living off of his savings. And Robert, he's living off his savings, but he still has the cash flow coming in, 833 a month. Last scenario. This is the same, except Robert buys 2 investment properties instead of 1. Remember, he had 252,000 saved up, and each investment property is 500,000, and he's putting down 100K each. So in this scenario, he puts down 200K for the 2 duplexes, and his savings dwindles down to only 52,000. And if you look at the equity, again, Robert has 204,000 in his primary residence. He has 52,000 in savings and 200,000 equity in the fourplex. So he still ends up with the same equity after 10 years. We look at the income, both still make 5,000, but Robert has additional income from cash flow. That's 2 properties that's generating $10,000 a year. So every month he's making 1,667. Again, monthly expenses, Robert's expenses are higher because he's still paying the mortgage, but the surplus cash at the end of the month, Robert has more than Dave because he has the additional income of the rental properties. If we fast forward 30 years, you can see that the difference in net worth is quite substantial, where Robert's net worth is almost double Dave's. And when they retire, Robert's going to have a little side income, whereas Dave's going to have 0. Now, some of you might think, well, stock market returns, this is not always 9%. And that's true. Sometimes it goes up a little bit less, sometimes it goes up more. Over the long run, you can expect about 9%. Now, even if we were to expect a really bad scenario, let's say, 1 year, let's go back to this scenario right here, where, after 10 years, Robert has 252,000 saved up, but that particular year, instead of 9%, the portfolio lost, I don't know, a large amount, let's say 50%, which is astronomical. He still has 125,000 in savings, whereas Dave has 0. So even though there's risk in the market, my contention is that Dave is more at risk because he doesn't have any savings. The problem is that Dave's extra money is going to the bank and he can't access it. Whereas Robert's additional money is invested by him and he has liquidity and access and control over his investment. So not only does Robert get higher returns on his surplus cash of 1302, he has more built-in safety and security compared to Dave, who got out of debt as quickly as possible. Yeah, this is pretty counterintuitive. So I've come up with some financial principles that I apply in my own life. Now, I'm not suggesting that any of you do the exact same. I'm just sharing what's worked for me. So here it goes. The first thing I do is I avoid any high interest consumer debts. I do have a credit card, but I make sure to pay off the balance every month. I don't pay interest on credit cards. So that goes without saying. Number two, low interest loans are okay. Now we have low interest mortgage and student loans. And my wife and I, we never make extra payments on those low interest loans. Instead, we opt to invest the money in higher return vehicles like real estate and the stock market. Third, this is important, live below one's means. As our income increased, we did not increase our lifestyle all that much. We still live in the same house, pretty small, low mortgage. Our cars, one of my cars is 14 years old. The other one is 6 years old, both paid off. And even though we like to travel, we keep it pretty reasonable. We stay in reasonable accommodations and we cook quite a bit to save some money. So I think this is a big thing where we live below our means. Fourth, save and invest the excess money. I try to make sure to put away 10% for retirement, 10% for savings, and 20% for investment. And if there's any money left over at the end of the month, it goes to the investing budget. Last but not least is buying cash flowing asset. Just like Robert from the example that we just talked about, we buy cash flowing assets. We had a couple of rental properties. One was a 3-unit, the other one was single family. And we recently sold them and bought apartment complex in Columbus, which cash flows pretty nicely and gives us some buffer in case of any unforeseen circumstances. So again, to summarize, avoid high consumer, high interest debts. Low interest loans are okay. Live below one's means. Save and invest excess cash and buy cash flowing assets. Listen, getting out of debt is not a bad strategy. I'm not knocking that. But I question the blanket statement that all debts are bad. And can we make a binary statement that everyone should try to avoid debt as much as possible? I think a lot of the concern comes from people over leveraging and not having any savings or buffer. And in those cases, getting out of debt is crucial, especially the high interest ones. Now, if one were to use leverage responsibly, let's say low interest loans, and using it to acquire cash flowing assets, it can be a tremendous boost to one's financial strategy. Not only will you get better returns than simply paying down your debt, you're also going to have access and liquidity to your investments, which actually provides more security and safety than getting out of debt. I would suggest that if somebody has high interest debts, try to get out of that as soon as possible. If you have multiple, maybe you can consolidate it, maybe even take out a home equity, cash out refi to pay that off, trade that off for low interest loan. There's a lot of options that you can do, but I think it's using a broad stroke just to say all debts are bad. I think there's plenty of ways where debt can be utilized as an amazing tool. Again, I'm not a financial advisor or an accountant. Always consult your financial advisor and accountant. Thanks for watching.